Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. Lots and lots of stuff to track. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, good morning. Well, the markets overnight didn't do too much, but the tweets keep coming in, whether it's from Mr. Trump, whether it's from Mr. Musk. Never a dull moment.
Negotiations on Truth Social. Tariff negotiations on Truth Social.
and the big, beautiful bill has now become what?
Abomination.
Yeah, disgusting and all of that.
It's a
mouthful. Exactly.
And what about Mr. Powell? He must be getting used to it, right? I mean, the data is weak.
Too late, Powell.
Let's just wait,
Keep your thing going.
I think, as a news person, right, as news people, I think this is the best of times and the worst of times, right? Yeah. Because there's enough to do, maybe a little bit too much, I guess.
But you know what's interesting is I think while we obviously track every single headline, and we do, and markets also look at everything, I think what the last 10 days have told us, I don't want to jinx it, is that markets have started looking through a lot of this noise.
Yeah.
Whether it's here in India, whether it's around the world, markets just seem to be in a mood that they want to keep marching higher.
And at the conferences that are taking place, that's the sense you get as well, right? He'll have to say something different or we'll have to require something new. Because as of now, this bad news at least is being digested. That's what it appears like.
No, absolutely. As they say, markets don't fall on the same news twice. I mean, so we've had... let's hope we don't get something new. But let's just take it from the top then, right? And what do you need to know? So actually, last night, US equities were absolutely flat. Nothing really. S&P was flat. NASDAQ was up 1/3% higher or so. The major theme really was weakness in US data. So you had the ADP private payrolls number which came through, which missed expectations. You would, more importantly, I'd say, you'd had the ISM services. Now, the services portion is the sticky part of any economy, especially an economy like the US, which is not manufacturing. It's all mostly services. And here, the ISM services number fell into contractionary zone once again. So those are, I think that largely was the broad kind of driver. And it really drove not equities, but rates. So you also basically had US 10-year yield, which lost about 10 basis points. That's a sharp fall to about 4.36%. Trump basically once again called how he's got these sort of monikers for people, right? He's saying, too late, Powell, to cut rates. He's unbelievable, essentially, according to President Donald Trump. Ties in with the fall in market interest rates, at least. Dollar index down about 0.4%, 98.8. Oil prices also came off a little bit, about 65 or so is where we left off. And there are some news reports which suggest that the Saudis want more supersized OPEC plus hikes in a push for market share. So the Saudis want to pump more oil, Saudi oil, and take more of the market. Remember, oil market itself is not growing, so it's going to be a bit of a battle in terms of who's able to pump more and sort of take away existing share. Just the other, of course, bit has been this entire battle around U.S. fiscal and the focus on U.S. fiscal risks. And it started yesterday morning. I mean, actually, when we woke up yesterday morning, there were those tweets from Elon Musk, right? Essentially opposing, he called that the bill an abomination. And then he said, well, come November next year, we're going to fire these people who are going to be voting in favor of the bill. And this is last night from Mr. Musk. He said, call your senator, call your congressman. Bankrupting America is not okay. Kill the bill. That is what is coming through from Elon Musk. And, it kind of raises the question, is this the first serious a crack in the relationship between arguably the two most powerful people in the U.S. administration? One, the president himself. The other, of course, not part of the government, but the richest person, of course, has been a big supporter, campaigner for President Trump. But we'll see. Now, the other bit, of course, came from President Trump, and this is with regards to Russia, Ukraine. And Trump essentially, in a way, broadcast loudly this bit, and it's kind of a bit of a head-scratcher. And just see what he said. He said, I had a good conversation with the Russian President Putin, but it was not a conversation that will lead to immediate peace. President Putin, and very strongly said, and very strongly, that he will have to respond to Ukraine's recent attacks on Russian airfields. So, I mean, in a way, it's like, broadcasting something to Europe that, heavier, bigger sort of retaliatory attacks are coming. But in any case, this is what really came through. Let's just tie in the levels here now and take a look at where we are at. Yesterday morning, we kind of put out that the range is essentially what we are looking at, 24,462 and 25,116. This is the range for the market. As of day before yesterday's close, we had come closer and closer to the lower end of that range. And yesterday we got a bit of a bounce, about 70 points, a third of a percent higher. Now, you need to take out 25,116 for upsides. But before that, there is a channel resistance on the Nifty at 24,750, I think, which will confirm further upsides. Between where we are and the 25,116 level, there's this channel resistance, so keep an eye. Support stands at 24,462, and then the 40-day exponential is 24,324. For the Nifty Bank, support stands at the 20-day moving average, which is 55,216, not very far away, about 1% away from where we left off yesterday. And resistance here is the recent high, day before yesterday's high, which is 56,161. Very short-term levels is essentially what we're looking at. GIFT Nifty should give you a quick sense of where we are likely to start. It's almost unchanged. That range, I think, still very much is the case, and that range holds for now. Surbhi.
Okay, well, Asian markets are very, very cautious because of the weak data that we've got from the US, even though the US markets were willing to shrug off at least a bit of it. But if you're looking at Asian equities right now, whether it's Japan, whether it's mainland China, markets are down. The only exception actually is the Hang Seng, which is managing to track a little bit of a gain. The data points, just to put them all on the table, the specific numbers, yesterday's this private sector report, the ADP report, showed that payrolls have increased by only 37,000. The estimate was 110,000. So the gap is huge between what was reported and what was expected. Not just that, the previous month's number was revised lower slightly from 62,000 to 60,000. So even if you compare it month on month from 60,000, the number has come down to 37,000. So job market, of course, and we are waiting for this, official payrolls report Friday. We'll have the full picture. ISM. Services indicators coming into contraction zone, 49.9. The estimate was 52. So that was a double whammy on the macros that, of course, heals the dollar and, in part, the equity markets were reacting to. ECB is in the spotlight today, and all bets are that they'll be cutting rates by at least 25 basis points as they try and deal with this tariff onslaught from the US. And, of course, we're watching out for the RBI. Similar expectations from the Reserve Bank of India as well. On Friday, that is tomorrow, 25 basis points is what is expected. The market has been in a range now for over 15 trading sessions. It's about broadly a 500, 550 point trading range. And what we're seeing is that every time we approach the lower end of that range, there is buying emerging irrespective of the news headlines. And that's exactly what happened yesterday as well. Both the Nifty and the mid-cap index, of course, managed to chug along higher. Block trade action, OFS action will still be in focus. But I guess, Nigel, overall, the backdrop is not too positive this morning, not too negative this morning.
Well, that's right. It's become very, very difficult to look at the institutional flow numbers because on every second day you have a large trade, or every day, in fact. So yesterday, if you look at it on a market perspective, the Nifty went up and there was some shedding of open interest on the Nifty itself. So some signs for the market on the whole, some kind of unwinding of short positions is what we saw. What about positioning? Not too much movement both on the FI as well as on the client side. So as we've been saying in the last few trading sessions, the FI as well, they continue to remain net short. Now the short contracts are at the higher end of the range at around 1 lakh contracts. Even in percentage terms, it's at around that 83% or thereabouts. While clients, they've been building on longs. They are holding on to long positions to the tune of close to around 70,000 contracts or thereabouts. But today is the Nifty weekly expiry that plays out. So expect some kind of movement in the second half of trade, particularly at that 3 p.m. move is something that I'll be watching out for. And the PCR, that's at the lower end of the range, 0.73 approximately. Yesterday, the reason that I was saying that we could have a green day is because it was at the, totally at the lower end of the range that we see, at around 0.64. Now it's moved up a little bit, but still it's towards the lower end of the range. Why is that? We have, yesterday call as well as put trading that we did see. So this 24,600 call, 24,700 call, the call writers, they believe they're going to defend a higher level. So in case we do get past those levels, then in fact those call writers or the bearish players, they'll get trapped on the wrong side. However, the 24,600 put as well did see some kind of open interest built up. 40 lakh shares out there getting built up. 71 rupees is the premium that they were looking to eat. And these contracts expired today, which brings us to the levels. In terms of levels you're looking at, on the downside, 24,500. That's the first reference point you're looking at. And you know the bulls, what they'll want us to get past the 24,700, trend towards 24,750, because as of now, positioning is such that this level does get, held out. And the other, the positive trigger that you're looking forward to is the Nifty golden cross. That's important. The golden crossover is important because, in fact, that means that the 50 DMA is on the verge of getting past the 200 DMA. So we are very, very close to that mark. This could be the positive trigger, actually, that the markets are looking forward to. So keep an eye out on that. I think that 24,450 level should hold out in the near term. However, can we get past the 25,100? That's the important mark. This, however, is an important positive technical trigger. Stocks that I'm looking at, ABFRL, yesterday there was a large trade. The stock moves into the F&O band. We'll keep an eye out. Yesterday's lows around 73 rupees odd. We'll keep an eye out on this stock today as well.
All right, well, keep an eye out on those names as we start to trade. Now, American billionaire and renowned hedge fund manager Ray Dalio has called the issue of US debt an urgent matter. It's been a long-running theme and an issue close to his heart for a long time. In a conversation with CNBC, he says that US debt issue is a supply-demand problem. He suggested a 3% solution to the deal to deal with the US debt crisis urgently. Listen in.
It's urgent because we are on the brink of the supply-demand. Just to put it in perspective, imagine you're running an enterprise, a company. You're spending $7 trillion a year. You're taking in $5 trillion. You have a $2 trillion deficit. You have a debt that's 6 times the amount of money that you're taking in. The interest on the debt is $1 trillion. That's 20% of all your spending and 50% of your deficit. And you can't cut the costs materially. You're at this point where as the debt then compounds on the debt and it's squeezing out. There's a path here. I call it the 3% three-part solution. 3%, get the deficit down to 3% of GDP. Spread it out. That means you probably have to change revenue and taxes, tax revenue and expenditure by about 4%. Squeeze in 4%. And if they do that, they will have probably a 1 to 1.5% decline from interest rates. And that will reduce the deficit by nearly another 2%. And that would be the path. That's what I call the 3% three-part solution. On both sides of Congress, I've spoken both sides, agree on the numbers.
Now, Dalio also commented on the Federal Reserve's policy direction, and he says a balanced measure is needed to reduce the debt and deficit. Take a look.
You can't unnaturally lower interest rates without a negative consequence. Think of it this way. A bondholder wants a certain interest rate, and that's measured by the real interest rate. And if you artificially lower the interest rate, then what you're going to have is the problem that it's a worse asset to hold. And that can be a problem. But if you change the supply-demand picture the way I'm describing to lower the interest rate, then that's a healthy way of lowering the interest rate. You don't get richer by lowering interest rates or printing money. So you have to deal with this in a balanced way, the way it was done really between 1991 and 98 as a general example. And if there's a depreciation in the value of the currency, there's a depreciation in the value of the debt. And because there's a need, because there's this problem and these imbalances and so on, this is a big issue. So the depreciation of the dollar is making, and the expectation of a depreciation of the dollar makes it less attractive to hold that. While the dollar in the 1970s fell against the alternative currencies, and it's probably likely that this happens again, you also have all the currencies falling in relationship to gold, goods and services, and so on, and then you can have an inflation.
Well, that's Ray Dalio, and of course, U.S. debt has been something he's pressed on for years now, for over a really long time. But now he's saying, well, it's a bit of a tipping point. Mark Franklin is Deputy Head of Multi-Asset Solutions Asia at Manulife Investments. Thank you very much for joining us, Mark. Prashant here. Would you agree with Mr. Dalio? And for investors or traders in the market now, are there any near-term implications? Will bond markets throw another tantrum anytime soon, do you think, that with fiscal risks looming?
Good morning. Well, if you look at the CBO, the Budgetary Office projections in the US, and then you layer on top of that the intentional spending and tax items that the Trump administration is attempting to pass through Congress, it does result in a further widening of the fiscal deficit from an already elevated level, and in absolute terms to a high level in the context of it being somewhat of a pro-cyclical fiscal policy setting. So there's definitely a question mark over the long-term sustainability of that path and the extent to which investors in US bonds will be willing to invest at current yield levels. Now, with respect to whether that will lead to another resumed bout of volatility in the bond market, don't forget we've already had a fairly pronounced steepening of the bond curve in the US and rising term premium, but the front end of the US Treasury markets, all the way up actually to the 5-year point, have been quite well anchored and pretty well bid by investors in the US Treasury market. And so what you're likely to see is a potential further steepening of the curve, but it's also dependent on the extent to which the economic data in the US follows a path of some kind of softening, because that will allow front-end rates to remain anchored and allow the market to continue to expect some rate cuts, which will also further steepen the curve. So it's not just about the fiscal path, which we would concede does raise questions, but it's also the development of the economic data and how that progresses in the coming months as well, because any sniff of a slowdown in growth, you could in fact see a resumed bid for bonds, given that the US 10-year up until the last couple of days was trading at a pretty interesting 4.5% to 4.6% level in yield terms.
Mark, hi. And, we've started seeing some evidence when yesterday's private sector payrolls report was quite weak. Let's see what the actual US jobs report, showcases on Friday. But my question is this: would you think that the direction in the near term for equity markets is still higher despite all this? Because even if data is weak, perhaps the Fed starts cutting. In any case, whether this is the big beautiful bill or the big ugly bill, as now Mr. Musk is calling it, the fact is it's adding a lot of liquidity in the markets. Generally, tax cuts, I mean, they're good for consumption, aren't they?
Many moving parts at the moment. Let's try and take some of those in turn. The first moving part is that we've had a very pronounced rebound in equity markets, a welcome rebound in global equity markets. And the rebound to some extent has been led by US equities, given that they had lagged the rest of the world for the first 3.5 months of the year. So we're at a point now where valuation multiples to some extent have priced in a fairly relaxed stance and expectation with respect to the outlook for tariff, trade policy and dynamics amongst trade partners with the US. So there's a certain degree of comfort that's now priced back into markets. That may well get tested as we approach that expiry of that 90-day pause in early July. But at the same time, the corporate earnings cycle and the share buyback cycle remains pretty solid, and the earnings seasons have come through just fine. And so from a fundamental perspective, if you take a snapshot now, there are reasons to remain constructive on risk assets. But going back to other moving parts as well, you mentioned liquidity injections into the markets. If you look at the US Federal Reserve and real yields, which is effectively a proxy for financial conditions, the Fed is running a relatively restrictive policy stance on the monetary policy side at the moment, not just in rate terms and real yield terms, but also in terms of balance sheet. The balance sheet continues to grind low and bonds allowing to be run off. And so it's really up to the fiscal side to offset that, and in some senses to inject fresh liquidity into markets. And there's another moving part as well. Whilst the House of Representatives passed the BBB bill, the Trump administration bill, it's now being run through the Senate, and there are definitely some voices reflecting the prospect that some amendments will be introduced to that bill, which will force it back to the House again. And the market, the equity markets, but also the bond markets will start to address probabilities of easy passage or amendment type passage and the extent to which that can be done quickly. And that will then lead to some marginal shifts in appetite for risk assets versus more defensive assets. So many moving parts at the moment. We've had a pronounced rebound. You can see a reason why equity markets can hold in at these levels if a certain set of things prevail. But you can also see as we approach the late summer months into July because of the tariff policy uncertainty, some investors may look to take some profit after this pretty sharp rebound as well.
All right. Hi, Mark. Good morning. Good to see you. Ben, Nigel on this side. I think you were overweight Asian equities. Do you hold on to that stance? And also, where does India fit in? The problem for India is that valuations seem to be restricting the flows that are coming into India. However, if you're looking at growth, then India is top of the ranking, right? So your approach to Asian equities, and where does India come in the pecking order?
Yeah, so our broader top-down view is we want a diversified global equities portfolio, which means not being quite at benchmark weights for US equities because the benchmark weight is so high, and using that sort of lightened up position to invest in more discounted markets from a valuation perspective, where the risk reward and the risk premium are somewhat more attractive. And that includes Asia as well. So we are fully invested in Asia at the moment, but within that, we're taking a somewhat selective stance. So you mentioned India. You're right to point out that the absolute trajectory for growth is region leading, but to some extent that's discounted in valuations. The RBI's room to start cutting rates again should provide some kind of support for the cyclical growth outlook and the extent to which that can drive a re-acceleration of bank loan growth. But if we take a step back on India, one of the challenges for the Indian equity market is because it's seen as a quality growth exposure where regional and global allocators feel comfortable over strategic time horizons to be fully invested in India, it kind of serves as an ATM, a source of funds when investors want to take more tactical, shorter-term, longer positions in markets which present an interesting setup. And I give you an example of Korea. We've just had the election there, a pretty clear outcome which reduces policy uncertainty, and it brings investors back into focus for the Korean market after a period of time where they've been on the sidelines because of political uncertainty. And India is a source of funds as people want to redeploy a bit more money into the likes of the Korean equity market, and early this year in the Hong Kong, China equity market as well. So India is sort of the core holding, but it sometimes gets used as a source of funds for investors to broaden out their exposure within an Asia context as well.
That's an interesting point. I mean, kind of explains, at least in part, why foreign flows have been very patchy into the Indian market. We mostly get very positive feedback on the narrative and the growth potential, but the money flow has been a little patchy. All right, Mark, thank you very much for the perspective. Thank you for joining in today. You have a good rest of the day, and we look forward to the next call. Well, with that, let's move on, and let me tell you about the interactions that are lined up ahead on the show. At 8:30 a.m., we have Deepan Mehta of Elixir Equities joining in. We'll discuss some specific stock ideas with him. At 9, Sandeep Agarwal of Soolio Investment Managers joins in to discuss the impact of AI on Indian IT. At 9:20 a.m., Rajiv Batra of JP Morgan joins in. He is our market master of the day. And at 9:30 today, remember, is World Environment Day. So we get a full conversation going on where is this green transition heading. Vinayak Chatterjee of Feedback Ventures and Nikhil Nigania of Bernstein join in to give us the big picture. A little later, at 9:50 a.m., Arun Shukla joins in from JK Lakshmi Cement to talk about the quarter gone by and the outlook ahead for the company. And towards the end of the show, in our special segment, It's the Economy, Lata today will be in conversation with Neeraj Seth of 3R Investment Management on global yields, rates, and currencies. All right, time for a quick break. Up ahead, of course, we'll focus on all the key stocks to watch, so be right back. Welcome back. Like we've been saying, a little bit of mixed picture across Asia. We had obviously a mixed close on Wall Street as well, and then Asian markets as well. Little cautious. These are the indices that are outperforming. The Hong Kong market is actually up and about, but if you look at the others, there is a cut of about 0.5%, for instance, in Japan, and there is some caution in other markets like Singapore as well. So we'll see how this plays out. Plenty of stocks. Let's actually get the implied open back up on the screen to see where we could start off, because yesterday the market managed to lift off quite nicely towards the afternoon, both the mid caps and the Nifty. So will the bulls continue to do that? Well, very flat. That's the indication, at least for the opening. What about individual stocks? We've got Ria joining in with a list of all the key names to watch out for this morning. Ria, morning to you.
Good morning, Surbhi. Let's take a look at the stocks that are going to be in focus today. First up, we have Gland Pharma. Since the company's arm, Senex's manufacturing unit has received 11 observations from French regulator ANSM. Escorts Kubota will also be in focus today. They've launched a new backhoe loader called BLX75 in their construction equipment segment. Moving on, HAL will also be in focus. They've clarified that they are not in talks with any other players other than GE on engines for the LCA Mark II aircrafts, and that negotiations with GE are on track at the moment. Newgen Software to also be in focus. They've bagged a $2.5 million order for a period of 5 years for digital transformation systems. Also keep your eye out on IEX and Dalmia Bharat, since Dalmia Bharat has sold about 1 crore shares at a price of rupees 201 in IEX. Home First Finance is another one to keep your eye out on today. India Ratings has upgraded the rating to stable from their earlier positive rating on this front. NTPC Green is another one to keep on your radar today. They've inked a PPE for a 1,000 megawatt solar project with a tariff of rupees 2.56 per kilowatt hour. And lastly, Angel One has come out with its monthly business update. The client base has gone up by around 34% on a year-on-year basis, but just 1.5% higher on a month-on-month basis. Average daily orders are up around 3.2% on a month-on-month basis, but down about 23.4% compared on a year-on-year basis. So keep your eye out on all of these stocks today.
Okay, all right. Quick fire coming in there from Ria. Thanks a lot for joining in with all those stocks that we'll be keeping an eye out on. So Ria's got us through all the stocks and news. But Sudarshan has woken up early and he's been reading through a lot of brokerage notes. He's picked up a few to tell us. Sudarshan, morning. Go ahead.
Good morning, Nigel. So I have a list of companies where today brokerage notes have come. First one in the list is Reliance Industries. JP Morgan maintains overweight call and target is rupees 1,568 per share. It believes that for Reliance Industries, earnings over the next 2 years should be better than the last two. And recently, the stock has been under pressure on large earnings cuts that were driven by weak commodity EBIT. But growth in consumer business should translate to a better bottom line as per JP Morgan. Next is Mahindra & Mahindra, where HSBC maintains buy call and target is rupees 3,470 per share. It says EV margin, that is electric vehicle margin, could improve to mid-single digits over next 12 to 18 months. Also, EV profitability could be even higher and may catch up with ICE vehicles. And over the medium term, HSBC believes that changes in taxation are going to be key for the stock. Next is PV Fintech. Citi maintains buy call and target price is rupees 2,185 per share. It says strong retail health insurance growth provides greater visibility into future profitability, and pickup in business activity at Bazaar should aid investor sentiment. Also, potential listing of another large player, HSBC believes that it will support pricing discipline and going to be positive for PV Fintech. Next is Wellspun Living, where Jefferies has initiated coverage with buy call and target is rupees 185 per share, which implies an upside of almost 40% from current levels. It says company is going to be a key beneficiary of India's potential trade deals with the EU and the US, but it believes that FY26 would be muted due to near-term tariff uncertainty, but over FY25-28, it believes that companies should deliver 18% EPS CAGR. So keep an eye on all these names.
Okay, all right, Sudarshan, got that. Thank you very much for a quick run-through of all the key brokerage notes as well for the morning. We'll take a break, come back on the other side, and we'll discuss some of these stocks and others with Dipan Mehta of Elixir Equities.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, Dipan Mehta, Director at Elixir Equity, joins us on the show. Hi, Dipan. Good morning. Good to see you, Ben. Dipan, let's talk about my home sector, which is cement, and the one that you have recently turned positive on. I wanted to ask you actually about Dalmia Bharat, because they've been holding 15% stake in IEX, And the street has been asking them numerous times. I as well have asked Mr. Dalmia here on CNBC TV18, what are you going to do with that 15%? When is a good time to sell? And gradually they've started this process just in the last 5 days. So in the last 5 days, they raised roughly around, close to around 300 crores by a sale of around 1.7%. In IEX, they still hold, though, close to around 13%. What's your view on Dalmia Bharat from here on? Because though the quantum is small, it's a move in the right direction. Their debt was around 700 crores, so that could come down by half. And they have ambitious plans to go from 50 to 70 million tons. So your view on this stock?
Yeah, Nigel, good morning and thank you for having me on your show. I think it's one of the larger cement players with an aggressive expansion plan. And as I said, we are getting constructive on the cement industry, although a bit disappointed with the numbers which came from Ultratech and Shree Cement. But yes, I think Dalmia Bharat also certainly is one of the stocks which may do well. But within the cement space, I think the top pick still remains ACC and Ambuja. And especially ACC, where there is still scope for improvement in efficiencies, which may result in better bottom line and expansion of capacity as well. But I think if you're holding shares of any of the cement company, the top 5, 10, 5, 6 players or so, I think you can expect decent returns. We have seen an uptick in government spending, and real estate also is revving up. I mean, in terms of the number of projects they have announced and launched in the last 6 months, all of them should start going into construction phase, so that should be supportive for cement demand. And overall infrastructure spending also will pick up. And the most important thing about cement companies is the base effect will help them from this quarter onwards. So although June quarter is one of the stronger quarters, and then we have the monsoon season, but the base effect will certainly benefit, and optically the numbers for the cement companies for the upcoming earnings season will look pretty decent.
Okay, that's a take on cement. Deepan, hi, morning. Now let me ask you about the stake that they're selling, that particular entity. So, the whole power space, IEX is one small part of the chain, but, otherwise today we're going to have a longer discussion as well on this whole renewable energy shift. But what's your take specifically on IEX? They keep getting, running into these issues with coupling, decoupling on the regulatory front. Your thoughts?
Yeah, good morning, Surbi. I think that's a big overhang on the stock. And if the government proceeds with this entire strategy or policy of coupling, then certainly it's going to have a major impact on the business model of the company. So if you look at the entire exchanges space, we've seen the price of BSE do well, MCX, and of course, an unlisted market, NSE also has climbed significantly last few months or so. But IEX really hasn't gone anywhere. And it's an excellent business if it can, run the way it is being operated at present under the present regulation. But we don't know when that particular axe will fall and what the effect will be after that. So for me, it's a avoid at this point of time. And I think within the power space, there are far more interesting segments and sub-segments which can offer very good returns with a high degree of earning visibility and sustainability of earnings as well.
And which ones would these be, Deepan? The other options in the power space that you like?
So basically, I think that by and large, the renewable power equipment manufacturers, they are the ones we should be focusing on. They're sitting on very good order book position. And at the same time, capacities are coming up pretty well over there. But within that, we have the solar equipment and we have the wind equipment. So within the two segments, we prefer the wind equipment companies. There are only two listed companies, Suzlon and Inox Wind. A disclosure, we and our clients are invested in them. I think the threat of competition is least for the wind equipment manufacturers. Basically, the Chinese cannot come and dump any of their equipment, and you cannot easily set up capacity the way we are seeing happening in solar modules and in solar cells. And look at the order book position of Suzlon and Inox Wind. It is like 3-4 year type of order book position and still growing. And now I think valuations also have become reasonable, mainly because earnings have shot up in the last 3-4 quarters or so. So within the entire power space and even within the entire capital goods space, I think these two companies are our top bets. Having said that, it's a disclosure, we are investing in these companies, so our views could be biased.
No, absolutely. I got that. Deepan, hi, morning. Good to have you here as always. PI Industries was a mover yesterday. I think it was up about 5% or so. Kumai Chemical Industry, which is, I think, a big client, customer, etc. for PIs up their revenue guidance. I think that was essentially what led to the move. Any thoughts here?
Sir, I think even I was surprised with the move, but I mean, we'll take any good news because we are investors in PI industries, have been so for the last 10 years or so. It's been a fantastic multi-bagger. And I remember you covering, as the channel covering this company also in depth as one of the India's greatest value creators. And basically, the company has had a few setbacks. Growth certainly has slowed down for various reasons. Management says it's transient. We don't know. But the real fresh growth, I would say the new growth story in PI is when they get the pharmaceutical, the CDMO business right, And if they are able to succeed over there, then it will open up vast opportunities for the company. And we can then see sustained growth in the high teens as we have seen over the past several years or so. But if they're not able to get that piece right, then I think by and large, because of the base effect and because of their kind of growth they have already achieved, the basic agrochemical business, I think that will start to stagnate or grow at much slower growth rates. So we are having a strong, a very cautious opinion on the company at this point of time. And let's just wait and watch how this pharma business evolves, because right now it is loss making. And even the growth, I think, is below our expectation. But if they get more contracts and revenue start to pick up in that division, then we'd get much more optimistic on the stock.
Well, that's right. I think from the pharma business, we had a chat with them, Deepan, and they told us that they like to gradually ramp up that business and hopefully it breaks even at ballpark 500 crores in terms of revenues, which is still smaller in percentage of the contribution. But that's the new segment that the street is bullish on. We note your view. Deepan, I want to ask you on brokerage companies because Angel One came out with an update. And also we had a chat yesterday with Zerodha. In fact, he said that they're expecting a 10 to 20% drop in brokerage business. That's the word that came in from Zerodha founder as well as CEO Nitin Kamath, who was speaking to CNBC-TV18 Shireen Ban after winning the EY India Entrepreneur of the Year award. Let's listen to that bite and go to Deepan for his view.
Broking business as such, I think, will still be down like 10-20%. But that said, we are kind of investing into other startups, and these startups have now maturing. So like there's insurance startup, there is AMC, etc. So I guess it has to be given some time for it to materially start impacting our revenues as such.
Okay, all right. So some kind of, downtick in terms of volumes, but that is par for the course, and that's something that, we were expecting as well. Deepan, what's your view on the brokerage business? Angel One, they have come out with an update. They're saying the client acquisition has mildly moved up on a month-on-month basis. The stock has seen a good rally. I remember, on our morning chart, we had highlighted that it was seeing good amount of delivery-based buying, and also there was a fair amount of long build-up. And the stock, I think, was around 2,400. It moved all the way to 3,000 rupees. At current reckoning, what's your view? They're going on to state that they're gaining market share in the F&O market. Your take?
Yeah, I think, Nigel, certainly it's one of the more aggressive players, and we will see steady growth in Angel as well. But if you look at the larger investment theme, which is financialization of savings and the entire fintech space, then I think there are better players and better stock ideas over there. Specifically with broking, I would prefer Motilal Oswal over Angel One, more so because they are also into asset management, portfolio management, and there's greater degree of, I would say, stability in their core business. But what happens in this company is because of the mark-to-market gains and losses, the numbers, the bottom line fluctuates a great deal, but the core businesses of wealth management and broking continue to do well for the company, and its valuation is quite attractive. But if you take the entire canvas of this capital market investment theme, in our opinion, the best secular growth stories, the great compounding growth stories are the wealth managers. And we have 3 listed wealth managers. All 3 have had a fantastic track record, and they are going, according to me, in the very right direction of getting more and more annuity-based revenues. And the wealth management business has got great dynamics considering the kind of wealth effect which we are seeing. And there's a mindset change also amongst the HNIs and the ultra HNIs. They don't want to do it themselves anymore, which was the case 5, 10, 15, 20 years ago. They want professional help, and these companies are able to provide that, and therefore they are growing their AUM The three companies, again, usual disclosure, we and our clients are invest in them, are of course Nuama Wealth, and there's 361, and there is Anand Rathi Wealth Management. And we prefer the wealth managers over the AMC companies also, over the exchanges, over the stockbrokers. In the entire matrix of capital markets, I think these are the companies which can grow on a steady basis for a long period of time.
Okay, all right. Deepan, stay with us because, and you may want to weigh in as well, right? We've got a global perspective coming in on commodities. Peter Maguire is CEO at trading.com. Peter, good morning. Good to have you with us here. Thank you very much for joining us. So even last night, you basically had what are described as safe havens, which rallied a little bit, but mostly on the currency side. Day before yesterday, you had that big move in silver. Silver prices shot up 5%. Gold's, of course, come off quite a bit from the 3,100 kind of lows. What's your sense? How are things set up for these two commodities?
Well, good morning, Prashant. I mean, when you're seeing what's happened as far as, and you look at the first part, US dollar, that's come under more pressure and it's under 99 now. So that US dollar index sitting at about 98.80. And in turn, as you mentioned, silver had a really nice rally. It's approaching that $35 handle. Gold's back at nearly 3,400. And you've also had bond yields taking a little bit of a dip. You've got your 10-year now sitting at 4.37. That's been sold off. So I think all of those moving parts, currencies had a big rally to the upside as far as euro. And a lot of, I think, smart money found a home in silver and gold in that short period of time.
Okay, all right. Hi, Peter. Good morning. Good to see you in. But people say that gold has been shining long enough. Maybe it's time for silver now to outpace gold. Would you agree, or do you believe that that won't be the case?
Well, Nigel, it is good to see you, and I feel as though if this is for the viewers, they need to do some historical data and some homework on this. Look at the gold to silver ratio and look at its long term, what it's been as far as that ratio. At the moment, it's probably close to, back of a postage stamp calculation, probably 95, 96, 97 to 1. But I feel as though that silver will take a rally to the upside, and I feel as though, underinvestment, as we've always said, over the last couple of decades, will come home to roost. The other side, of course, is industrial demand and all the other usages as far as silver. So, yeah, I think silver's got more sunshine ahead of it than gold.
Okay, interesting. All right. Peter, the other point that we look at from an India, both equity as well as commodity market perspective, is crude oil prices. Supply seems to be ramping up. Demand seems to be a little bit soft as well. Brent, though, holding at around that $65 per barrel mark. What's your take?
Nigel, I think a couple of things. First off, I'm very interested to see what the kingdom came out. When I refer to the kingdom, I'm talking Saudi. And I think there'll be an oil glut come Q4. It could be even in the tail end of Q3. That glut is going to be very interesting how that takes charge as far as market and price. So I think over the end of Q2, leading into Q3, I think prices will come down a little bit from here. But I think certainly leading into Q3 and really into Q4, they'll be significantly cheaper from here. When I say that, could be down $8 to $10 a barrel. What's going to be the key driver, I think, is going to be where that 411,000 barrels of extra production in the sense of output, you're going to see, and this is what the kingdom's calling for, Nigel, is that to be rolled through into August and September. So I think it's going to be good for consumers and certainly for India.
All right. What are you making of steel price trends as well, Peter? Because, President Trump, he's gone ahead. He's doubled the tariffs out there on steel. So in the near term, maybe there was some pre-buying that we saw just in the near term. Though demand trends coming out of China are still rather weak. What's the range you're looking at on steel prices?
Well, I think, where it is at the moment, if I look at ore, you're looking at iron ore just under 100 or around that sort of benchmark. I feel as though with the tariff situation, no doubt that President Trump wants to gain momentum as far as manufacturing internally in the US and the deals that he's structuring. So I think you're going to see a little bit of volatility across that sector in the short run. You've got copper also sitting at 9,600. So there's going to be a dollar to be made, but I think it's going to be fairly range bound until we move further into Q3 and get this tariff situation under control. And then you get some real opportunity to see where I think the smart money will find a home across some of these industrial metals.
All right, Peter, since you briefly mentioned copper, from base metals, what are you most bullish on?
Copper, I like it. I mean, it seems to be slowly trading up, Nigel, back at that 96 handle, 9600 that is, metric ton on the LME. So I feel as though that you'll probably see further upside, maybe take 10,000 out this month. It's going to be a long month, June. And I think the overall momentum will be a little bit stronger than where it is at the moment. Demand's strong and there's plenty of infrastructure. You've only got to look at that most magnificent city you call home. Have a look at how much copper would be going in and steel into, the infrastructure of Mumbai.
All right, it's always a great conversation. By the way, so oil glut coming, right? That's quite interesting. Sorry, I missed that, Peter. You said prices dropped to what?
I think they could be down $8 to $10 from here, Prashant, and I'm talking at the end of that Q3, Q4 sort of level or time frame. And the oil glut. This is what the kingdom's saying. They feel as though that there will be a glut, and this is obviously it's a game of brinkmanship. They want to see compliance across OPEC and its allies. That's the kingdom, that is. And it seems to be, if you've got too much supply, you know that as well as anyone, you're going to see cheaper prices unless you see something dramatic happen from a Mother Nature perspective with hurricanes or if you saw geopolitical.
Yeah, no, absolutely. Deepan, if you're listening to the conversation, any thoughts? Basically, what Peter is saying is oil prices are headed lower. I mean, directionally lower. $8, $10 maybe more, and there is a glut coming. From a stock market perspective, Deepan, any thoughts?
I think it's great news for India, and I think coming from an expert like this, it kind of resonates with me because the way the China demand is going, and the shift towards EV, I think lower oil prices are going to be the norm. And what is happening is there is competition within the oil producers to retain or increase market share. So that's great news for consumers and especially India. As it is, our fundamentals have improved, the macros have improved, and this, I think, will further aid that process. And right now, I think, as I see, the only real major roadblock for the market is this July 9th deadline about Trump tariffs and how they play out.
I was hoping you'd weigh in on OMCs, etc., because that's probably a lot of excitement. There are committed investors here for OMCs, Deepan.
Yeah,
I know your view, but if this is the case, if oil's headed much lower, any thoughts?
I think, but the real question mark is whether the government will let them keep those profits, because there's always a case for, taxing them directly, indirectly. And we have seen that at even lower oil prices, these companies really haven't thrived. But yeah, I think that sentiment can improve and you could see a trading rally in these companies at any point of time. I heard even volumes have picked up. I think petrol volume was up 9% or so, and diesel was, I think, 2-3% higher. So that also will benefit, and especially BP, HPL, a lot of big expansion plans going on stream. So, I mean, I don't like the space because of its past track record, but I think there's a case for a strong rally in them. You could definitely justify it.
Okay, all right. Peter, had more questions out of time, but thank you for joining us on short notice. Really appreciate your views and perspective here on CNBC-TV18. Deepan, stay with us. I want to address, of course, financials as well ahead of the RBI policy meeting. I mean, the Reserve Bank of India is set to announce a rate decision, should I say rate cut. A CNBC-TV18 poll does suggest that they will cut repo rate by another 25 basis points in this meet. Ritu is here with some of the key expectations, and we'll get to stocks and financials in particular.
Well, we're going in with the expectation of a hat trick with the Reserve Bank's Monetary Policy Committee expected to cut rates for the third consecutive time because inflation has remained well below the 4% target. The first quarter number is likely to undershoot the forecast, and so it will be very difficult for an inflation-targeting central bank to not deliver a cut. Now, while 90% of the respondents to our poll expect a 25 basis points cut in this policy, a smaller section believes a larger 50 basis points cut could boost the credit cycle and lift sentiments. The repo rate, currently at 6%, is expected to go down to 5.5% in this cycle, and that would mark the shortest and the shallowest RBI rate cutting cycle in over a decade. A smaller section is expecting the terminal rate at 5.25%, but overall this will imply the space for a total of 50 to 75 basis points of more cuts from the current levels. Most expect RBI will stop cutting rates by December, some even by August. The GDP forecast for the year is most likely to be left unchanged at 6.5%, but RBI will take note of risks from the rising global trade uncertainties. On the inflation front, though, a revision is likely. With CPI inflation under 4% in the last 3 readings, a majority of our poll expect RBI to lower the 4% forecast by 10 to 20 basis points and possibly more, which will support future rate cuts. As for liquidity, most feel RBI has already done a lot. With a record high dividend transfer, core liquidity is also expected to remain in surplus in the coming months, so don't expect big action on that front. But here's what else to watch out for. Any tweaks to the liquidity management framework for one. There's also been some chatter on whether RBI may introduce the external benchmark linked rate for NBFCs as well to ensure that there is better transmission. And of course, the street will watch out for any commentary on the global macro outlook and how that might impact India. But bottom line is, this is a policy where RBI's rate cut could be predictable, but its guidance and tone is what the markets will decode more carefully.
All right, Ritu, thanks very much for prepping us up. So all set with hopes of a 25 basis points rate cut. Thanks for that. We'll take a quick break. Come up on the other side. We'll have Sudarshan Sukhani joining in along with Mitesh Thakkar, get some technical perspective on the market.
Okay, welcome back. 6 minutes to go for the pre-open session. Sudarshan Sukhani and Mitesh Thakkar are with us with what they'd like to do as we start another trading day. Gentlemen, good morning. Great to have both of you here. So we did get that bounce, and I think both of you were biased on the long side, looking for trades. So let's just, as always, get the indices out of the way first. Mitesh, what would you recommend?
So Prashant, on the indices, I think, we still maintain that the range consolidation might continue. Neither the bank Nifty is getting past 56,000, nor the Nifty showing signs of getting past 25,050. So a few more days of consolidation is likely to happen. And the idea is that on the lower side, around 24,500 is your entry point, which is the lower end of the range. And from there, you can take a 70, 80 point kind of a stop loss and try to take profits when the bounces come in. So I think that's the approach in the short term.
Okay, all right. Mitesh got that morning. Sudarshan, coming to you. So what's the sense? I mean, it seems the market wants to go higher. The indices want to go higher. At least that's the indication we got yesterday. But what's your trading bias for today?
Yeah, good morning. Well, the markets are still in a trading range, and you're right. But the problem is that a trading range can become almost random. So the market is still not sure what it wants to do. A small breakout in any direction would be worthwhile. Within that trading range or within this nothing market, the Nifty is finding repeated support at 24,500. So that was a suggestion yesterday. It continues today. With that as an approximate stop loss, go long and stay long. If you're long, fine, nothing to do. If you're not long, you should look to go long. And that is your approximate exit price. Till then, be on the long side of the market.
For targets on the upside?
Well, targets, see the market trading range is 25,000. If we get a decent up move, we could go all the way there. But targets are always a guess only.
Okay, all right. But you're saying buy into the Nifty. That should be the trade with 24,500 as an important stop loss. Got that. So Darshan, also if you could give us your picks for the day.
Yeah, and Nigel, it's all mid caps. You should be knowing far more than I do about what small caps and mid caps are doing. You're the expert. But with whatever, Jubilant Foods is a buy with a stop under 673. LIC Housing Finance is a buy with a stop under 591. Torrent Power is a buy with a stop under 1394. And Gujarat Gas is a buying opportunity with a stop under 464. This is just 4 stocks. Actually, I would think there must be many small caps doing well.
All right. Thanks a lot for that, Sudarshan. In fact, I enjoy covering and explaining all these names on CNBC-TV18 over the last 14 years or so. And, the recent segment as well, Mid-Cap Microscope, has got quite a good feedback. So maybe I should work on a few more. Thanks, Sudarshan, for that. Well, Mitesh, coming across to you. what are the individual stocks that you're focusing on?
So, Nigel, I have all buy calls today. The idea is that while the indices are not showing any signs of movement, I think the stocks are showing you trading opportunities, and that's where we are focusing upon. A buy on Astral Limited with a stop at about 1500 for targets of 1570. Buy on CESC, which I would recommend buying with a stop at 165 for targets of 178. Geo Finance is a buy with a stop at 285 for targets of 300 plus, and JSW Energy is a buy as well. Keep a stop below 500, look for targets of 530.
Okay. All right, gentlemen. Thank you very much for all that trading advice. We'll come back to you closer to market open. Right now, we'll take a quick break. Come back. We'll, of course, have the pre-open rates. Also, we put the spotlight on the IT sector, among the worst performers in the market this year. So what's the way forward as the AI disruption unleashes across the world? Sandeep Agarwal of Soilio Investments joins in for some perspective. Welcome back. We are keeping the conversation going. Dipan has been waiting by patiently. And, okay, look at the Nifty in the pre-open. First rate, 300-point pop. I think this will settle in all probability because we've not seen this kind of excitement in most Asian markets. Let's see how it plays out. The reason we're getting that pop is right now because of some very big outsized trades on ICICI Bank, TCS, on the big boys. So let's see how this plays out. The sensex is a little more measured. The gain on the sensex right now in this session is about 0.3, 0.4%. That's the sense we have. Dipan, yesterday we had a big move on Swiggy. And very, very quietly, Eternal has been making that move higher as well. Not quite sure what the market is sensing. I think there's been a lot of chatter about the next round that Zepto is going to raise. And let's see what valuations they get. Then the listed guys get excited as well. So not sure if that is a rub-off. Otherwise, how are you placed on both of the listed stocks, Swiggy as well as Zomato?
I think I have a different theory. We are getting into a risk-on trade in our Indian markets as well. And these companies, which are typically darlings in a bull market, now investor attention, trader attention is shifted over there as well. They have underperformed. Yet at the same time, long-term growth dynamics are very good. And a lot of other growth stocks, now valuations have gone to that expensive zone. So I think in a way, these companies are just about catching up. We all know these stories about Swiggy and Zomato, and I think they're pretty well discovered and pretty well, I think, analyzed as well. So all I can say is more liquidity flowing into these companies because of a risk-on trade in the Indian markets, maybe led by domestic traders and domestic mutual funds more than the FIIs.
But do you like them? I mean, do you own them or do you like them, either of them?
Yeah, I mean, we have an investment in Zomato, which is Eternal. But, I'm not looking at it. My view is let me see what happens in 5 years, So unless you don't have that kind of a long-term vision in these companies, you may get stocked out because of the volatility which is there in the stock price and the earnings as well.
Okay, all right. That's an important caveat that you're looking at these businesses with a really long-term view, 5 years, let the dust settle. And there's probably plenty of dust and rubble going around as the pricing wars also continue. Got it. Dipan, thank you very much for joining in. Great to have you on this morning. Well, with that, we're talking about technology companies from the new age internet tech. Let's go back to old world tech. I'm talking about IT services. We have Sandeep Agarwal joining in, needs no introduction, a veteran in this space. He's, of course, from Soilio Investment Managers. Sandeep, good to have you on. I mean, and we wanted to sort of have a little bit of a context. Earnings season is over. We know what the stocks have done. They've done nothing. I mean, the worst performers so far this year. And there is this rapid AI transformation going on one side, and then the whole tariff-related issues and whether US businesses will spend lesser, etc., whatnot. I mean, how are you looking at traditional IT services at this juncture? What lies ahead next 6 months to 12 months?
Yeah, hi, good morning, and thanks for having me on the show. So I will just quickly in 30 seconds tell you what we saw in the results. So in results, it was very interesting. The guidance was quite weak or subdued because there was a cautiously optimistic approach, while deal flows were good. So, and if you see the end customers of all these IT companies, IT services companies, most of them, Procter & Gamble to all Southwest Airlines, any company which we track, Ford, they have either withdrawn guidance or they have, cut down guidance. So the challenge is that even the end client doesn't have a clear visibility because of the tariff uncertainty and how the economy in the client market will do. And that rub-off effect is there in the commentary and the guidance of the Indian IT companies as well. The way we look at it, is very clear that there are two particular spaces in this industry, which is traditional IT services, where Infosys, TCS, HCL, and all of them are there. And then there is a ER&D space where, there are some players like Coforge, KPIT, Persistent, and all. I clearly believe that ER&D will grow at 2.5 times of the traditional IT services space. But if IT services space is going to grow at 6-7% year over year on a sustainable basis, and we gain some market share and we make it 8-9% also, and ER&D grows at 14-15% for a longer time frame, then also the PEG ratios are very, very demanding at the CMP. And because the PEG ratios are so demanding, other than the high cash distribution and dividend yield, there is no other story to play in this stock. So I think these stocks, the large cap IT names, are defensives in your portfolio, but they may not give return and can undergo massive time correction the way we have seen in last few months. That is what I see.
Since you mentioned ER&D, Sandeep, the stocks that come to mind would be Tata Elxsi and KPIT Technologies.
It is hard to comment on name of the stock, but yeah, all the stocks, KPIT, Tata Elxsi, Persistent, and Tata Technologies, all of them have do some or other work in that space, and that space is very, very good from a longer term perspective. But again, I won't be able to buy at this PEG ratios, which are insanely high in my view.
Even Tata Technologies, which when it listed, people were talking about big targets. The stock is almost halved from the peak.
Yes. So the challenge is, as I said, that for how much multiple you can assign for something which will grow at 7-8%, and how much multiple you can assign for something which will grow at 12 to 14%. In my view, good quality companies, good management, and good cash generation, you can assign maybe 2.5 times PEG ratio. But unfortunately, nothing is available at that PEG ratio also. So I think, the way these stocks will react is that no one wants to sell them because they provide them the cushion on the uncertainty side. But at the same time, no one would like to do incremental buying. So I think, IT sector, we have some same view for last 4-5 months now. And we continue to have that view. We made big money and we had big position last year. We were massively overweight. That time, no one was willing to see at the sector because sometimes, there was news of salaries postponed, the variable pay postponed and all. I think that was the bottom of the sector. And now I think it is a time correction phase. And as mentioned earlier, the AI is going to do a lot of disruption because the efficiencies will keep on going up, the efforts required will keep on going down, and that will reflect in the number of amount of manpower you can take. So the revenue volume growth will be much lower. Maybe little bit of revenue growth could be there that is more driven by efficiency.
Speaking of IT sector salary hikes, I don't know if you guys caught it in all the news flow.
I did.
Mr. Salil Parekh.
22% on that sort of a base.
22% salary hike. It's a neat sum of 80 crores right now. Yeah. Average IT sector salary hikes otherwise 5 to 7%, right? I don't know. I'm not saying anything, just stating the numbers.
It's a touchy and it's kicked off a firestorm of opinion, right? On social media and elsewhere. Sandeep, on the AI bit, right? I mean, things are moving so fast and I'm talking about the consumer products which are available, which you and I can use. I mean, it's capable, as you said, less and less effort, productivity growing by leaps and bounds. So eventually, on the enterprise side as well, and now if you heard Eric Schmidt in his latest talk, he's talking about agentic AI to really flood the markets early next year. We've been sort of disrupting slowly. I don't know if it will be sudden big disruption, one day. Not one day, but what's your sense? And that's a big risk, isn't it?
No, so disruption will be very sudden. I am not of the view that it will be slow. It will be very sudden and it will be massive. But the good thing is that this disruption, when they happen in initial 2-3 years, it takes time for them to stabilize, and that is the time when human intervention is at the peak. So let me put it this way, and this is a very contrarian call to the street. In my view, next year probably when this disruption comes in an explosive way, you will see a lot of human interference and interaction between, and you have to do that. And that is the time when Indian IT services, when people will stop looking at the whole sector. I think that is the time when again this sector will be right to give you quick 30-40%, and then again will be like a time correction phase for 1.5 years. So it will move in this cycle till this disruption is settling down. So in my view, we are at the beginning of a big disruption right now. So you will have time correction for 6 months, 9 months. When disruption sets in, then there will be a lot of human interventions which will be required to set it. And that is the time when growth will come for some 6 to 9 months, 12 months period. Everything will look good, like we saw in post-COVID. And then again, things will go slow. So, and you see the applications are going like mad, as you rightly mentioned. You see the products which are coming from Dyson, the products which are coming from all the other consumer-facing companies, also in defense. It is madness. Like, things are changing at a very, very fast pace.
Yeah. I almost am tempted to stop tracking all this and jab sab kuch settle ho jayega, fir dekhenge. But I think Sandeep's view is good, that he's saying next year you get a 30-40% upside opportunity. And then maybe, the sector goes to sleep once again. But that's only next year. Sandeep, thank you very much for joining us. Great conversation as always and good perspective on the space. Let's just quickly get the calls out of the way. Sudarshan and Mitesh are back with us. 9-10 calls. Sudarshan, what do you have?
Well, it's LIC Housing Finance. Consider buying it with a stop under 591.
Okay, Mitesh?
I'll go with a buy on JSW Energy for targets of 530.
Okay. All right. Thanks very much for that, gentlemen. Well, let's move on to a very important story. This big exclusive coming in. CNBC-TV18 has learned that RBI is internally discussing whether to allow foreign banks to have a higher shareholding in Indian banks. The current limit is 15%. The internal RBI discussions are on to raise this particular limit. We have Lata joining in with this exclusive. Lata, this is very interesting. And I mean, I'm supposing the context of the backdrop is Sumitomo's interest in Yes Bank, right? I think that time it was being discussed whether that should be a one-off, if it should be just a special case exemption. But you're saying this could be a sort of a wider overall reform.
Yeah, what we are learning is that RBI has been discussing for some time whether foreign banks should be allowed a higher ownership. And sources say that unless RBI comes to an internal agreement, they will not put it up for public discussion. These are people who have been in the past in these kinds of discussions with Reserve Bank. Now, let me tell you the reason for my increased conversation with my sources was because of a Reuters story reporting this morning that RBI is signaling rule changes that will allow foreigners more shareholding in Indian banks. Now, what are the current rules? Current rules is 15%. For any foreign institution. So that's bank, a foreign financial institution is what they mean. Now, there have been individual cases, 2 cases. Catholic Syrian Banks is owned by Fairfax up to 51%, and now SMBC has been allowed to own 20%. In both cases, they had to take special permission. I must tell you what are the detailed rules. There are a whole host of rules for foreign banks. There is an overall limit that, once you cross 5%, you have to take RBI's permission. Only then you are allowed to come even to 15%. On a case-by-case basis, 2 cases have been allowed to go to 15%. But I think it might, the discussion is to make it a general rule, is because, IDBI is also in the market looking for a buyer. That's the government, and LIC are looking for a buyer. And even Money Control broke the news that Emirates NBD is one of the front runners. Clearly, they would want to have more people interested in it. Now, what we understand, the other constraints on banks is, if there is a foreign bank branch, it is severely constrained. Like if HSBC is a branch, Standard Chartered is a branch, they have very severe branch licenses. If you're a fully owned subsidiary, like SMBC set up, then you have the same restrictions as an Indian bank. Overall ownership, FPI plus FDI in banking is 74%. So there are all these rules, but the overarching rule is no one entity can have more than 26% voting right in any bank. This is not an RBI rule. This is the Banking Regulation Act that again kind of hits against an Emirates NBD or a SMBC who want 50%, 51%, but who can get only 26% voting rights. But that is not under discussion. It's not even the RBI's purview. And finally, will Indian private sector manufacturing companies be allowed to own, stakes in banks? I believe that is also not up for discussion.
All right.
This foreign ownership, whether it should be opened up all the way to 26% or not.
Well-regulated, widely owned foreign institutions like banks, That is the one that is under discussion.
All right, Lata, thank you very much. Very good perspective on that. And it's a story which we will continue to follow here on CNBC-TV18. Reliance is something we want to focus on, and Wellspun Living as well. Sudarshan is standing by to tell us why. So, good morning.
Morning, Prashant. So, JP Morgan has it a note on Reliance Industry. It maintains overweight call and target is 1,568 per share. It believes that earnings over the next 2 years for Reliance Industries should be better than the last 2 years. It believes the stock has been under pressure on large earnings cuts that were driven by weaker commodity EBIT, and growth in consumer business should translate to better bottom line. That's what JP Morgan believes. And one is Jefferies on Wellspun Living. It has initiated coverage with a buy call and target is 185 per share, implying an upside of 40% from current levels. It says company is going to be a key beneficiary of India's potential trade deals with the US and the EU, but believes that FY26 would be muted due to near-term tariff uncertainty, but over FY25-28, it believes that company is going to deliver 18% EPS CAGR.
All right, well, so right on time. Thank you very much, and we'll keep an eye out on those two names, Wellspun Living and Reliance. 24,667 is where the Nifty started at. The Nifty Bank is at about 55,800. It's higher. It's a good start, about 0.15 and 0.2% on those two indices respectively. The sensex is at about 81,100. The small cap index, much better, about 0.6 higher. And I think the mid cap index should also be looking up at this point in time. And that's essentially where all the action has been, even though, and this is the third week running, the large cap indices don't have very much to show on them. So, you know, but mid and small caps have continued to, the pace of gains week on week for the last 3 years kept on coming off for mid and small caps as well. But, you know, that's still looking good, relatively speaking, to large caps. That's the heat map on the Nifty. It's predominantly green, and there is some red out there as well. Let's do stocks now. Surabhi.
Okay, Eternal is climbing once again. I mean, Eternal has been on quite a spree. So far this month, about 5.5% up. This morning, it's about 1.3% higher. Reddy's is having a very, very good morning. Almost 3% up on Dr. Reddy's. Actually, supply is also not too bad. So some of the pharma names have started off on a positive note. Power Grid, Shriram Finance, Geo Financial, these are some of the other early movers. Trent, HDFC Bank, that's what we have. IndusInd Bank, TCS. So it's a very mixed bag. It's hard to say whether any one sector is pulling away, early on. On the weaker side, what is weak? Axis Bank, SBI Life, HDFC Life, Bajaj Finance. Financials are very, very mixed. I mean, you can't say banks are up or down. It's really all over the place. Tata Consumer, Lever, Nestle. Consumer stocks are down. So that's an early, easy trend to spot. And then everything else is pretty mixed and muddling along. Now the Nifty is, barely holding on to a gain, about 6 points higher. So volatile and not too steady with those gains, at least so far. Nigel.
Well, that's right. In terms of stocks that are reacting to news, NTPC Green, they have signed a PPA with the UP government for around 1,000 megawatt project. And the tariff has been fixed at around 2.56 per unit. So, that's why, in fact, that stock, I think, is moving up. It's up close to around 3%. So, news-based move out here. Newgen Software, they bagged a $2.5 million 5-year order from Digital Transformation Systems. So, that stock as well is up and about, relatively small in size, but the stock is buzzing. IDBI Bank may be, in fact, a rub-off effect from what Lata had to tell us with regard to probable, some kind of leeway with regard to foreigners holding stake in an Indian bank. So that one has been moving well. Today as well, it's up close to around 2% approximately. So big move being seen on that one. The other big winners I can see is Jacob. That's moving on fairly decent volumes in the first stake. Purvankara, that's another big winner. Both of them, good moves is what we are seeing. And BSC, oh my God, just take a look at that stock. It's up close to around 3% as we speak. From the recent lows, it's seen a solid rally. So that's clearly the stock that's running on steroids over the last few trading sessions. Big moves being seen on that one. And as we did that market check, on expected lines actually, the Nifty went to around that 24,700 odd mark. And from the top, has seen some come into profit taking. The Nifty Bank underperforming yet again. That's down close to around 50 points.
All right, well, and the Sensex is just about ticking into the red at this point in time. So it's flattish kind of trends as expected and as we've discussed as well. Nifty Bank is slightly in the negative as well. Well, Rajiv Batra is now joining us. He's head of Asia and co-head of Global Emerging Markets, Equity Strategy and Chief India Equity Strategist at JP Morgan. Rajiv, great to have you with us here. Thank you very much. And you're coming back on the program after a while, so welcome. And at the outset, let me say, we hope to see you more often, Rajiv. With that said, what's the dominant driver, to your mind, for markets here in India, primarily here in India, and world markets as well? There's no dearth of news flow. It's almost head-spinning. But what is the dominant driver? Because there is a lot of noise, but there is some signal as well. What's the signal?
No, definitely with earnings season getting over, markets is looking for fresh catalyst. And I do believe macro narratives over here will be very critical. This week, we are having trade talks happening between US Trade Representative and India. So all eyes will be on them. RBI monetary policy meeting on Friday. Like JP Morgan is calling for 25 basis point rate cut, and majority of the street is also discounting that. But any incremental dovish tone or some positive surprise can lead to big upswing, and then followed by macro data point. Remember, since February, we have started seeing green shoots coming in India. In fact, to put cherry on top, this recent GDP print also was a positive surprise overall. So in that terms, if momentum keeps on building on that, India market will benefit. Coming back to the global market just want to hear one news: what is going to happen on trade tariff side. So in that side, if the noise keeps on going down or start looking much more on a better tone, then market will be in much more a happier shape. We have seen recent increase in steel and aluminum tariff that has increased some bit of a risk premium in market. Beyond that, very close eye on the harder data points on the US, particularly employment or non-farm payroll print, which will dictate the course, whether US growth is on par or US growth is sliding. So taking all into account, yes, a lot more data watching like central banks we are also doing, and that will dictate the market direction.
Okay, Rajiv, hi, morning. Great to have you on the show today. So the question that we're asking is that where is India in the mix? The answers that we usually get are that the market seems okay, but the flows really haven't building. I mean, they're very patchy, foreign flows. So what is the sense that you're picking up, and what is it that is still making foreign investors maybe a little sort of sketchy on taking that big India call?
So foreign flows is not just should be a concern for India only. Foreign flow is a concern for entire emerging market. You'll be surprised to know, at least in case of an India, we have started seeing some bit of a flow, close to $2 to $3 billion over the last month or so. But when we look at an emerging market, the YTD situation is still negative, where year-to-date term flows are still 15 to 16 billion down per se. So even if money has started coming out from the US, the first stop it has taken is in developed market ex-US. So markets like Europe, Singapore, Australia, Japan, they are the one who have benefited on the first bout of flows which has come in. Now, when you expect it will build and it will then seeping into emerging market, again, the debate comes around whether US exceptionalism there is in place or not there is in place. Once market get convinced, okay, the trade noise is coming down, they start revisiting back the growth avenue in the US, and hence you have seen rally or rebound in S&P 500, NASDAQ, that followed up some amount of a rally in the tech-driven name. In that particular scenario, domestic market like India suffer, or other emerging market where you don't get that consistency in flow. So I don't anticipate this gyration of US exceptionalism is over or is in the process of a slowdown or it is still alive. With this keeps on going, that will impact the flows pattern into EM, and hence it will have an impact on flows pattern on India also. It's not just a verdict on India growth. Yeah. It is more on what is the growth differential between the US and the rest of the world.
No, absolutely, and take your point entirely, because that money that's been leaving US shores, Europe has been the first port of call. Do you see that changing anytime soon? Or will this pattern continue at least for the next several months?
It can definitely change. Remember, like people who have shifting to Europe are still taking a neutral kind of a call on the US, and then hence they are taking an overweight bets on European markets. But the day they start getting marginal underweight or underweight on the US, then you can't be just sitting overweight in Europe only because the allocation is different. If you look at MSCI Equi or Global Index, 65% weightage is US in benchmark, and the rest of the world is 35. In that, you cannot place all the bets on 15% on Europe if you are taking an underweight call on the US. Then you need to take an overweight call on the entire rest of the world. Hence, emerging market can come into play. Remember, emerging market is not a big bucket. It's like 10% of the universe. So even a few drops of inflows also can make emerging markets fly.
All right. Hi, Rajiv. Good morning. Good to see you, Ben. Nigel on this side. I recall the conversation we had in September 2024. Things were looking up. The markets had run along. Flows were fairly okay. The problem was the fresh supply of paper. And we know what happened from October onwards. And you were sounding a little bit cautious at that point of time as well with regard to the amount of supply because it was draining out liquidity. How are you feeling now? Because in the last 1 month or so, promoters have decided we run the business, but maybe we can book some profits as well. And we've seen some MNCs as well take some money off the table. Your take on this?
Thanks, Nigel. Yeah, the problem which we were facing in October, that problem, small bit sense have started coming back, which can be seen in performance also. Month of March, India rallied and outperformed rest of the world. Month of April, the same story prevailed. In month of May, we went up 1.5% in dollarized term, but we underperformed Asia and the other emerging market. Yes, definitely higher oil prices or even the trade truce benefiting other export nations was a reason, but the key reason have been increase in supply of paper. So if we are seeing increase in supply of paper with markets still lacking an earning growth story, then what will happen? People will start shifting away again from the secondary market towards the primary market or to additional issuances. For both primary and secondary market to do well, we need a double-digit earning growth handle. And that is missing in India for the last 4 quarters whenever we look at their YOY growth. Sequentially, when we look at the last quarter, fourth quarter FY25 sequential growth, it has shown a double-digit handle. But we need on YOY basis and consistently. Then even the supply of paper will be absorbed and secondary market may not get disrupted. Here now people have an excuse that I can take money off secondary market because you don't have earning catalyst. And yeah, because of better valuation or liquidity availability, let me shift back to primary markets.
Do you see that changing? Rajiv, same question like the flows question. Take your point entirely. I mean, there's no debating that, right? Earnings have disappointed. This is the first quarter. Fourth quarter was the first quarter. We didn't get big downgrades. In fact, if anything, there were pleasant surprises. Do you see earnings coming back in India?
I'll say definitely yes, it is coming back. This is not something new we are seeing for first time. Over the last 2 decades, we have seen how the policy cycles and how growth reacts to the policy cycle. So historically, it's take a 2-quarter lag for growth to rebound in terms of a lag impact when monetary policy changes the course. This time, if you look at the rate cut situation or liquidity injection, that was the story of around January and February. By that means, growth should have appeared in the June quarter itself. But here we have to give them benefit of doubt and say it could happen with 3 quarters lag because at the same point of time, you are seeing external slowdown happening. So taking that lens into account, I still believe it will be a story of a September quarter, which will be an acid test for our earning growth to appear. But in this June quarter, you will get another benefit beside all the policy actions, plus you can say monsoons getting better over there is base effect. Remember, first half, whether you look at the first quarter FY25, second quarter FY25, your base have been quite low. So with growth data points reciprocating plus base effect, you may start getting into 10 to 11% growth handle, but either it will be first quarter FY26 or it could be the second quarter FY26.
Yeah, no, absolutely. And I think that's well put. Rajiv, in terms of flows, right, which are coming into, so this is feedback that we have gotten recently as well, that, most of the money which we get, foreign money that we get is through global emerging market funds. I think we've spoken about this in the past as well. Global funds, big global funds have got very little exposure. But that is starting to change apparently over the last maybe 1 year, maybe the pace has picked up. What is your sense? What can you tell us?
No, so definitely it can pick up. Right now, when you look at the current situation, it does not show that global investors are fully back into India over here. And we have seen what our banking sector have seen in terms of an outflow during the month of January. And that huge amount of a banking sector outflows was nothing but linked towards these global guys were saying final goodbye to India because of growth being missing over there. Now, with the same kind of a global guys coming back in search of a growth, their first stops have been banking and the financial industry. And hence, you have been seeing last 2 month, 3 month, or you can put 6 month length also, taking domestic flows into account, that banking sector has making a comeback. So very anemically, they are making a comeback. Remember, India is no longer in global benchmark, also few basis point market. India is now sizable 1.5–2% kind of a market in global benchmark too, which means rather than just owning India through passive route or owning them through one name, now you need to own at least 2 to 3 names per se. But is it happening currently at this juncture? No. Are they doing their studies, analysis to revisit India's story? Absolutely, yes. Everyone has started working on. With question mark appearing of US exceptionalism, people are looking at multiple growth avenues. With 1.2% real GDP growth, you cannot be sufficed with the Europe. India, with offering you even in the range of 6–6.5%, have become a beautiful story for most of my global investors. But it will take time. It cannot happen overnight. You need to give them 2 to 3 years to become an overweight in the global benchmark also. The first stop will be Asia and EM benchmark, where we need to become overweight again for fund manager brigade. And then we can think about IFA, that is global ex-US, and then global benchmark.
All right, I'm feeling good, Rajiv. I'm allocating my money to the right place then, because I'm hoping that in the next 10–15 years, the kids will be proud of me. That said, Rajiv, I want to ask you how you're feeling about the markets. Headline index seems to be okay. But, when we spoke sometime towards the end of last year as well, we were saying there is signs of froth in the mid and the small caps. And that's the way it played out. We saw a sharp pullback, but plenty of stocks now have started bouncing back. What's your sense with regard to this mid?
Nigel, answer to all this question in India is never a valuation. It's all the growth. India's story started getting question mark because it was growth that has started coming down, and growth came down because of a twin policy tightening. Out of that, partially we have already seen policy reversal have now happened from a monetary side, and fiscal will see how things pan out in future. Now, taking that into account, yes, in case of a mid and small cap, think about if the quarterly growths were getting to single digit or even a negative zone also. Why this mid cap and small cap are making comeback? Look at the fourth quarter earnings season, where growth are again looking in high teens, double digit handle at a broad index level, but led by selective groups of stocks or sectors and the themes per se. So if growth continue to persist, which I do believe, then definitely mid and small cap make a comeback. But in terms of a preference and bringing in not just the growth, but even the global value investors into the play, large cap is looking much more lucrative because we are 12% above average valuation versus mid and small cap, all thanks to recent rally. We are now 35–40% above average valuation mark. So value guys may not appear in our mid and small cap spaces, but they will largely go with the large cap only. But growth guys, where the good news fourth quarter have shown us, if that continues for coming 2 or 3 quarters too, then I believe mid and small cap will make a comeback again.
Okay, all right, got that perspective, Rajiv. So earnings just have to revive, and you think that, that could be around the corner as well. There are lots of tailwinds that seem to be adding up. On that positive note, we'll wrap up this discussion. Thank you so much for being with us. We look forward to the next one soon enough. Well, with that, just a quick glance at the market, which continues to consolidate, but the bias once again has turned positive. So now the Nifty is cruising along. We've got about a 100-point up move on the index, and actually the Nifty is doing better than the mid-cap index for the morning at least. So it's looking good, and it seems to be advantage bulls. Well, with that, let's move on to the next theme that we have chosen to focus on today. Today is June 5, which means it's World Environment Day. And this is, of course, a day that's observed around the world. So we thought it's a good idea to put the spotlight on India's own tryst with the energy transition story. Where are we? Are we moving along as quickly as we would want to? What are the roadblocks? And what lies ahead for investors? How can they better participate in this entire story? Vinayak Chatterjee, co-founder and managing trustee of the InfraVision Foundation, is with us. And we have with us Nikhil Nigania, director, senior analyst at Bernstein. Gentlemen, thank you so much for being with us. Nikhil, I have to start with you because I opened your recent note. And there could not be a more catchy title. And for the benefit of our viewers, I want to say this is the latest Bernstein note. And it says, is energy transition really a green scam? And are we set for a second coming of thermal? Nikhil, start there. Why do you say this? Why are you raising this question? Yes, we might be behind, a little slow on that target of 500 gigawatts of renewable power, etc. But a green scam, really?
So yeah, I mean, the title is actually a statement by the US president. That's why the title came. I think the statement was more by him. That is energy transition a green scam? Or even a Chinese.
Okay, globally you meant. I thought you meant for India and our targets. Got it. So you were, paraphrasing the US president. Go on. And we know where he stands on things like, global warming and energy transition.
When you prefaced the question, I was thinking, in Trump era, is it still called World Environment Day?
That's actually true. God knows. Should be the fossil fuel day, right? We should be celebrating that. But anyway, Nikhil, go on.
Correct. So in the case of India, at least our stance has been quite clear and rightly so, right? I mean, climate change can't be denied. And India has been very forthcoming in pushing the green agenda. The 500 gigawatt target for 2030 is sort of percolated within the industry across ministries as well. Where do we stand now? As of now, we have about 230 gigawatts of renewables, which is including hydro, solar, wind combined. Globally, that puts us on number 3 in terms of renewable capacity. So we have not done that bad. We have done quite well, actually, in terms of renewable capacity addition. The way forward, though, reaching 500, our view, it's not an easy task. There are multiple challenges, largely on grid evacuation being the number one. And second is land availability, large contiguous land parcels for solar and especially wind assets, which we see as roadblocks for us to hit the 500 gigawatt number that we have planned for. And the second part of the statement of the title you mentioned is there a second coming of thermal? So in terms of investment as well, our preferences have been consequences of renewables rather than renewables themselves. So investing in the grid, which is a constraint, or investing in thermal, which is necessary as well from an investing standpoint.
Sure. Okay. Let's bring in Mr. Vinayak Chatterjee as well, of course, a veteran watching the whole infrastructure space and, of course, within that power. Sir, what would you say? We know that there are roadblocks in terms of the grid capacity, like Nikhil mentioned, how to ensure that we get renewable power at the peak evening hours. That's where the battery storage systems become so important. How do you rate where we are at and what needs to be done to expedite things?
Look, I think on World Environment Day, the broad fact is that India is well set. If you recall, at the COP26 in Glasgow, we had made a commitment of net zero by 2050. And as Nikhil just said, we have a capacity target of 500 gigawatts of renewables by 2030. The pace at which things are going, there is very high probability that we will meet both these targets, the near term and the long term. Interestingly enough, while we traditionally define renewable as wind and solar largely, remember there's quite a bit of buzz on green hydrogen as well as nuclear. And these need to be brought into the discussion now. Many large corporates, Reliance, L&T, etc., are all having fairly substantial backroom project operations on moving into electrolyzer, captive generation for green hydrogen, etc. So we have to count that in green capacity. However, even closer is the recent announcement about small nuclear reactors or Bharat nuclear reactors under PPP mode, which the government has announced. And there we have, again, a very happy target of 100 gigawatts of nuclear power. Now, nuclear, across most analysts, and Nikhil can vouch me on this, is nuclear is also considered not just clean, but is also considered green because it does not emit fossil fuel, gases, emanating gases. So all said, we are well set with the addition of both of these. If you asked me about challenges, the real challenge is to find a fine balance between coal thermal and renewable. If you recall, last week, the headlines were full of a very major breakdown in Europe, in Spain and Portugal, where suddenly something happened to renewables and the system crashed. And the discussion came back to saying that we must have a confident base load level of coal thermal and build renewable on that. And I think with that story and India's growing consumption of electricity, thanks to the economic growth, I think the discussion has come back once again to not completely shunning coal thermal, but building fresh capacities in coal thermal so that there is a fine balance in the entire system between base load and renewables. And finally, to wrap up the other challenges on renewables right now is very simple. There are PPAs that are waiting to be executed, and project developers are a little worried about the pace of signing and implementation of PPAs. Storage is an issue between pump storage and batteries because many of the bids that are now coming are for 24/7 power. So we have to very, very quickly gear up our storage infrastructure. If there's going to be 500 gigawatts of green energy by 2030, we need minimum 200 gigawatts of storage. Then there is the issue of grid connectivity. And then there is the issue of tariff, the global tariff war, the uncertainty regarding import and export of many solar and wind equipment. So let me stop here.
Right. No, absolutely. By the way, on that, Mr. Chatterjee, morning, Prashant here. Nikhil, good morning to you as well. That target by 2030, does that include renewable as well, Mr. Chatterjee? The nuclear as well? I mean, a certain...
No. That target was decided before this big push in nuclear happened. So the nuclear policy is an add-on, but assuming the target remains the same, then it increases the probability of meeting the target.
Yeah. On a side note, it's always debatable, right? Is nuclear is obviously not. Is it renewable energy? Because it's not renewable exactly, but it's recyclable. So I guess it's
on
clean.
World Environment Day, it is certainly green.
It's green. I think that's what matters. Nikhil, the latter part of the answer where Mr. Chatterjee highlighted some of the challenges, right, with regards to PPAs, etc. What's the state of play? Because you are in touch with pretty much all companies here building out some of the solar and wind capacities. Can you take us through it?
Yeah, so challenges on renewables, as I said, one is on the execution side, where grid and land become the constraint, and second is on a future pipeline side, whereas Mr. Chatterjee said the PPA signing has slowed down a bit. That is a concern. But if you think of it, India tendered a lot of renewable capacity last 2 years. That's primarily the reason why PPA signing has become a bit slow. That combined with power demand softening the last 2 months and even merchant power prices falling to zero, we saw a week back or so. So these three reasons, a lot of tendering, slower power demand and low merchant prices is why PPA signing has slowed down. But it's only a function of time. It's a year or two out. I think we'll again see the pickup on PPA signing. So personally, we are not too concerned on PPA signing near term. But yeah, execution side, evacuation and land, that's a bigger concern for this year and next year is what we see for the space.
Nikhil, from the investor's perspective, it just boils down to how do I play this cycle? And if someone's willing to sort of be in it for at least 2-3 years, then do you see enough opportunity in current listed players? The thing with the solar guys, I mean PVs and modules, etc., is that there's constantly a lot of talk of overcapacity and what if China starts dumping around the world, etc. So what part of this story do you prefer? Solar, wind, or do you think that the existing large generators, I mean players like NTPC, Tata Power, they themselves have, are setting up substantial renewable power, even nuclear in some cases, for instance. So what's the best play for an investor?
So from an investor standpoint, one can, within renewables, one can look at the equipment suppliers, as you rightly mentioned, the solar manufacturers or the wind equipment suppliers, or the utility players which are there. We, on the module manufacturing side, we do see a supply glut a couple of years out and the valuations to be rich. Hence, that's one area we are underperform and not very optimistic from an investment standpoint. Even on the renewable developer side, the valuations are not cheap. Hence, that's not a space we are positive either a lot. But the consequences of renewable, as I mentioned, the grid being a massive issue. So transmission as a space is something we like. We are positive power grid, and even L&T, I mean, one of the executors helping us build those assets. And beyond transmission, the other consequence of renewable is need for storage, need for thermal as well, which we just discussed. So that's where NTPC comes in with sort of doing both, right? It's doing thermal, it's doing renewables, it's doing storage and nuclear as well. So that's where we, that's what we like as a space, transmission and NTPC like a thermal or a conglomerate building across the value chain.
All right, Nikhil and Mr. Chatterjee, thank you very much. Quick conversation, but of course, I mean, it's an ongoing one. Appreciate it very much here on CNBC-TV18. Well, I think a market, by the way, just look at the Nifty, is taken off like a rocket. Initially, there was a bit of a dip. The low today was made at 24,613. And we are about 120 points off that level. Actually, we're up 120 from the close yesterday on the index at this point. And our market breadth is very healthy, almost about 4:1 advance to decline ratio. We take a break. We're back. We have the management of JK Cement to talk to us about the quarter gone by and their outlook. Stay tuned.
Welcome back. Well, let's focus on our domestic theme. That's cement. JK Lakshmi Cement, that's the next management on our radar. It reported a solid set of numbers in Q4, and the street is optimistic on prospects of FY26. Mr. Arun Shukla, the President and Director of JK Lakshmi Cement, joins us on the show. Hi, Mr. Shukla. Good morning, and thanks a lot for joining in. Well, tell us, what were the signs in terms of demand on ground, as you started off this quarter? And this early monsoon, has it spoiled the plans a little bit? What kind of a volume growth can you deliver in FY26?
Good morning, Prashant, and thanks to you for having me here today. Yes, we had a very good quarter last quarter, and things have started, moving well from third quarter on. As far as demand goes, I think things are all right. Typically Q1 is good, and despite early monsoon, I don't see any kind of setback in terms of demand. So things are all right on demand.
All right, Mr. Shukla, this is Nigel on this side. Just wanted to quantify that. If you could quantify for Q1, what kind of a volume growth have you delivered? The same quarter last year was obviously on a low base. We had elections and, various other problems. But for Q1 so far, what is the volume growth? And for the year, you've been talking about outbeating the industry. So what kind of volume growth should we work with?
So, Nigel, I think Q1, I think last quarter, the same quarter last year was not good because of elections and capex has got delayed. But Q1 looks to be good, and we see that industry is going to grow at the rate of about, let's say, 6-7%, and we are going to be in alignment with that. Maybe I think we'll do a little better than industry.
Got it. All right, you'll do a little bit better than industry. Let's focus on pricing then. The positive surprise in your numbers was even on pricing on a sequential basis. I think you had close to around a 5% recovery in pricing on a blended basis. How do you manage that? And also, when you've joined us in the past, you've said your focus is on increasing the premium segment as a percentage of trade sales. So what is the number at currently and where is it headed?
So premium, Nigel, we are at 25% of our trade volume and we are doing very well. Perhaps we are the best in the industry in terms of premium volume. That is one. I think we have been doing a lot of activities in terms of, improving our, top line and hence also the price which we get from the market. Just to let you know, in the month of January, we launched Green Plus brand, and perhaps we are the first one in the industry to launch a green cement, which is having the least clinker factor. So that has also helped us to improve our price positioning in the market and hence also, in terms of price growth with respect to previous quarter.
Okay, all right. And from 25%, where will it go with these new launches? Do you see scope for improvement in this year itself and maybe in a 3-year time horizon? Where is it gone? Where will it move?
Our plan is to take it to 30%, and I'm talking about premium product, and we call it Pro Plus cement, right? JK Lakshmi Pro. And Green Plus is our base brand, right? So a major volume comes from Green Plus. And the premium product, which is JK Lakshmi Pro Plus, is about 25% now. We are going to take it to 30% in maybe coming 1.5 to 2 years' time.
Okay, and the pricing difference between premium and normal sales is how much?
On per bag basis is about 25 to 30 rupees in different markets.
All right, and I think your core markets will be North, Gujarat, and I think parts of East as well. In these markets, if I compare the Q1 average, Q1 of this fiscal average, in comparison to Q4, is there a pricing difference? If yes, what will blended realizations look like? Will it be higher?
Prices are flat. If you look at Q4 prices last year and Q1 this year, prices are almost flat. Prices have not gone down, but at the same time, prices have not gone up as well. So I see that prices are going to be about range bound only, and I don't see that it's going to be a major increase over the last quarter in terms of pricing.
Okay, pricing flattish. Let's talk about the other part then. On the cost side, you all have been focusing on green power and renewable power as well, and that obviously helps the cost of production come down. For this year, what kind of cost of production reduction? That's FY26 and FY27 as well. You have some kind of a plan. So on a yearly basis, how much will cost of production reduce? Because that's in your hands, right? Cement pricing may not be in your hands, but what you can do internally, that's what's going to help you in terms of profitability.
Absolutely, Nigel. I think this is what we have been doing before, right? So we are working inwardly, and if you look at the EBITDA per ton gap, which we had with the leaders in the industry, now we have bridged it up quite a bit, right? And we have been working internally and particularly on efficiency part of it. On the renewable energy front, we are doing quite well. We are already at about 50% when we exited last quarter. Our plan is to take it to 53% by end of FY26. So this is one major actions which we are taking. Second is, of course, I think I told you the brand rejuvenation which we have done. Green Plus we have launched is doing very well, and also premiumization of our product in the market. So that is second thing. Third, of course, we are doing on the non-fossil fuel uses. We are already at about 10 to 11% on a console basis. Our plan is to take it to 15% by end of this year. So I think we are taking a lot of actions on efficiency part of it. Not only this, we are using technology to improve energy efficiency and throughput in our kiln and mills. So we have deployed algorithm and AI module in different plants. And on supply chain front, we do have kind of end-to-end digital integration, and by which not only we are giving differentiated services to our customers, but also we are trying to kind of make our value chain more efficient. So I think all these actions which we are taking now.
Focused on pricing, focused on cost of production, which brings us to the goal. EBITDA per ton. Last year you did ballpark around 650 rupees per ton. This year, given the measures that you're taking, should we work with an EBITDA per ton of around 850 rupees per ton? Should that be a fair number?
So I think we are doing quite a bit. I think the plan which I just enumerated, I think is going to give us about maybe 75 to 100 rupees a ton on internal efficiency, right? And if prices are going to go up, then I think that is going to over and above.
So 200 rupees per ton improvements is okay for us to work with?
I think 1 year time horizon, 1 year FY26 exit, we see that improvement of about 75 to 100 rupees a ton, internal efficiencies.
Yeah, but then there'll be pricing as well, right? So we should work with around 800, 850 rupees per ton of EBITDA?
I think we are quite optimistic. The kind of actions which we have taken, which I told you, is going to give us definitely a good improvement in terms of EBITDA margin.
All right. Very quickly then, by when does that merger take place between Udaipur and JK Lakshmi Cement?
So that is at a very advanced stage now. Maybe I think it will take another couple of months.
Okay. And what about the debt in your books? Currently, what is it? And given that you have an ambitious plan to move from, I think, 16 million tons, you're going to be moving to around 22 million tons in the near future. And then the ultimate target is 30 million tons. Could you quantify the absolute debt currently on a consolidated basis? And where is that headed?
On sole basis, we have a net debt of about 1,300 crore and net debt EBITDA is about 1.51, right?
Okay.
And yes, I think we have a plan to go to 30 million ton, but maybe within next couple of months we'll reach to 18 million ton because we are expanding one of the plants grinding station in Gujarat. So that will take us to 18. And along with that, the 4.6 million ton which we have announced that will take us to 3 million ton.
Very quickly, sir, in the next few days, it's going to be a cutoff with regard to bidding for JP's asset. Are you all interested? Have you all submitted a bid?
So I think any opportunity we look at from a strategy point of view, and perhaps I think this is not fitting into our overall strategy.
Got it.
All right, we'll leave it there. Thank you very much for joining us with that perspective. Appreciate it. Well, let's move on. Now, the topic for auto industry globally, of course, has been China refusing to ease its export restrictions over the supply of rare earth magnets. This has been a concern for many global OEMs, and they've been saying, well, we are weeks, maybe a month away from a large-scale production shutdowns. Remember, it was in April of this year that China implemented export controls on medium and heavy rare earth magnets. And China does not control all of the rare earths themselves. It's the processing capacity which China has. Now, by some estimates, inventory with companies was about 2 to 3 months. Since these restrictions came into effect in April, I think it's about now, that is in the month of June or July, that inventories perhaps start to run out. So let's get some perspective going on this particular topic now. What we'll do is, before we go across to our guests, let me just play out some of the views that we got from companies like Mahindra & Mahindra, Tata Motors and others, and then we'll bring in our guests this morning.
The whole supply chain of the world resides in China. So if this is true, we are still trying to come to terms with the facts, all the facts. But if this is true, it would mean that, and if it doesn't change, then in a matter of weeks, the entire Indian EV industry will grind to a halt.
I would be wrong in saying that we don't have dependence on this. There is dependence. As SIAM president, SIAM as well as ACMA both are very closely interacting with the government. Government has been very supportive on this issue, in terms of reaching out to the Chinese government also, the relevant ministries there. And we hope that the issue might be, taken care of.
This EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Okay, let me welcome in our guests now. Mahesh Babu is CEO, Switch Mobility. We have Hemal Thakkar, a Senior Practice Leader and Director at CRISIL Intelligence. Gentlemen, good morning. Great to have both of you here. And I think you heard from pretty much the top guys in terms of auto companies there. Mahesh, let me start with you. Is it starting to hit? Will it start to hit? How far out are we in terms of, some of these disruptions, production disruptions coming into effect?
Prashant, first is not only India. I think we should understand that the whole world is affected, because China has brought this across Europe, US, India and other countries as well. So 70% of the mining of rare earths are done by the Chinese companies. And almost 90% of the refining is done by the Chinese companies. So the world is dependent about 90% on supply chain from China. Now in April, China has introduced a policy of licensing to export rare earth magnets and metals to the country. So auto industry have been working. The procedure has been kept about 45 days. All our suppliers have applied already, but unfortunately we heard we'll have to apply through some Ministry of External Affairs about 20 days back, and our suppliers have again applied. So it's a question of disruption right now in a short term. We also have to think about long term, because if 90% of the rare earth magnets are going to come, and India has a vision of sustainable mobility through electric, then through Atmanirbhar, we'll have to, as industry, look at mid-term, short-term and long-term perspectives. So short-term, the industry has to work with both the governments to see how the licensing process.
Right. Mr. So let's just break it down a little bit, Mahesh. First up, where are these magnets used? Is it more used in two-wheelers? Is it more used in four-wheelers? Is it used in both? What about EVs versus ICE? Is there a differentiation? used in one or the other or both? And are these critical that, that vehicles can't be produced, or can vehicles be produced without them?
Most of the permanent magnet synchronous motors, which we call as PMSM, is almost 70% of the motor production, which is the main drivetrain. Both in you can take across two-wheelers, three-wheelers, four-wheelers, and commercial vehicles. Almost 70% are permanent magnet synchronous motors, which needs rare earth magnets because it is high temperature resistant magnets and they need it. So almost 70% of the industry on PMSM is dependent on it, mainly the drivetrain of EVs. Apart from that, there are also other motors across the vehicles which are maybe less sensitive to rare earths, but still needs magnets on it. So the whole supply chain of magnets and rare earth minerals are dependent on it. So 70% of the whole EV industry, from two-wheelers to commercial vehicle, everything is affected due to the supply chain disruption in the magnet.
So it's not it's critical. It's at the heart of motors, etc. So without it, there is no production possible across two-wheelers and four-wheelers, right? That's essentially what you're saying.
Absolutely.
There were some news reports suggesting that with these licenses, it's eased up a little bit for companies in Europe, etc. In terms of Indian companies, we've not seen anything yet.
So the procedure for application just got eased out. Everybody was hoping, our suppliers were hoping that they will be able to complete the process by mid of June and end of June, because they started in April. So some of the companies across Europe, US, India, everybody is trying. I think it is in a sequence which is getting approved. The challenge is uncertainty. If it gets approved and the supply chain starts by mid of June, I don't think any disruption for our production at least will happen between July and going forward. But however, this uncertainty has created a lot of supply chain challenges. If it happens, we welcome. If it doesn't happen, then the situation is it's going to take another 30, 40 days, and there is going to be a disruption in the manufacturing. The manufacturing line of automobile includes many manpower. So if you look at auto industry fully, and particularly EV with about 2 million plus vehicles being sold last year, it will easily to 1,000 to 3,000 manpower will get affected if there is no supply chain disruption directly, and indirectly many more will get affected. So we need to be cautious of that and then take action on short term to get this process done. As told by the other people, through CM, through FICCI, through other auto bodies, we have been working with the government, and government have been supportive. Now we hopeful we will debottleneck in a couple of weeks.
Thanks for that perspective, Mr. Babu. I mean, there are some reports indicating that I think China wants to have a better tracking mechanism and therefore continuous reporting from companies that indeed get the licenses for these magnets. Let's see how this plays out. Let me bring in Hemal Thakkar into the conversation as well. Hemal, what is your assessment of the situation? Mr. Babu just told us that, I mean, these magnets are so critical that you basically cannot manufacture without them. So there doesn't seem to be any workarounds or a go-around. What would your assessment be of the current level of inventory? I don't know if we have even worth of how many weeks, and what happens from here on?
Yeah, so thank you for having me. I would actually tend to agree to what Mr. Babu said and what even Shailesh mentioned. You can't run away from the fact that there is dependence. But I really don't see that, this is a situation to panic at this point of time. Our internal assessment suggests that, in June, we may not see much of an impact. We are relatively good, from a June perspective. But if this gets further prolonged, then, we will see more impact from July onwards. Again, when we look at segment specific, we feel two-wheeler ICE and three-wheeler ICE will probably have the lowest impact. But, when it comes to EVs, we feel that the electric vehicle will possibly have a higher impact, especially where PMSM motors are used. Because today magnets are used in many applications within, the automobile. But for other applications, if they are not rarer, you can still live with it and you will still be in a position to manage them. Also, our interactions with many manufacturers indicate that, there is a workaround that they are trying, but, it will take some time for some breakthrough to come in. So, over the next 4 to 6 weeks, if we do not see a major resolution on this front, then we are looking at we are staring at a problem.
So by July, if there's no breakthrough, then by July, this could start hurting. Anything additional you want to add on the bit of the workaround? You know, in India, they say that when we have our back against the wall, we come up with all kinds of innovative solutions. So this is more the four-wheeler manufacturers. They are thinking of the workarounds, or is it the two-wheeler guys? I mean, what are you hearing?
Everybody will think of a workaround because they would want their production to go on, I can see Mahesh laughing, so I'm sure, even they are looking at something, where they would want to have a workaround, but, workarounds cannot be done overnight. There is reasonable time that they will have to spend into it, to ensure that a resilient supply chain is built. And I would tend to agree to what, Sudarshan also mentioned earlier. This is, a clarion call for us to localize more as compared to, what we've done now. And hence, this is very, very critical that long term, from a structural perspective, we will definitely need a workaround.
But Hemal, I mean, it's very true, right? Look at the entire chip manufacturing ecosystem that we're setting up. The birth was, it kind of came from a space 2-3 years back when we had a global chip shortage, and we realized that we cannot be so dependent. For rare earth magnets, I mean, do we have the wherewithal to even set up capacity? Because we need the rare earths first, right? Those minerals first.
Yeah, so same is the case, with respect to battery. If you see, chemicals are something where we may not have access, but we will still be, kind of producing cells. So, from that perspective, yes, maybe with respect to raw material, we may still be dependent, but we can still put up processing capacities. Like Mr. Babu alluded earlier, that 90% plus processing happens in China. So if we are having access to material, 30% which is still outside China, we may still be in a position to make the supply chain more resilient.
Okay. But that panic thing, as they say, right? If you want to panic early. Hemal, in terms of order of impact, you're saying four-wheelers most impacted? At the other end of the spectrum, it's two-wheeler and three-wheeler ICE. Two-wheeler and three-wheeler ICE is what you said, right?
Yeah, two-wheeler and three-wheeler ICE possibly the least impacted. Even passenger vehicles ICE this month, there may not be a material impact. But, in the subsequent months, if, the issues don't resolve, then we may start seeing some impact on ICE. But EVs, yes, from July onwards, if there is no resolution.
No, I'm not talking about June or July, Hemal. As fundamentally, I mean, say, for example, tomorrow, if everybody runs out of rare earth magnets, I'm saying who's most impacted, who's least impacted?
So least impacted would be two-wheeler ICE and three-wheeler ICE, followed by PV ICE, I would say, and CV ICE. PV and CV, you can, have it very similar, but the least impacted will be two-wheeler and three-wheeler ICE.
Okay, got it.
And the top would be a four-wheeler EV, followed by two-wheeler and three-wheeler EV, right? Most impacted.
Yes.
Okay, all right. A good conversation, gentlemen, and I think it's something we'll continue to track as we go on. Mahesh and Hemal, thanks very much for joining us. It's a pleasure having both of you here for that discussion. We'll take a quick commercial break here. We're going to come back, and Manisha is going to be with us with a focus on commodities, what's top of mind. Stay tuned, coming up.
Welcome back. Well, let's get you the latest from the commodity markets. We have Manisha Gupta joining in. Manisha, what's the headline? What's the big news today?
Well, I'm looking at the iron ore prices, Surabhi, because this is an area which has seen constant declines in the recent few days. Well, we already are working with the higher tariffs when it comes to steel. And because iron ore is a major ingredient for steel, we have seen prices here continue to decline as well. So when you look at the prices in US, we're trading at an 8-month lows there. And when you look at the prices in Shanghai, we're trading at around 2-month lows onto that one as well. Well, it really has to do with on how you're looking at the markets there. Because when you look at the last 1 month, we've seen the prices decline by 3%. And in this year until now, it's been a 10% of an average decline that we've seen come in for the iron ore prices. Well, various reasons for that. I'll begin with the international markets first. And we are dealing with the 50% tariffs right now for steel. And there also are concerns about China economy. We're looking at weak manufacturing data from China, the lowest in last 2 years. That same has been the case with the US numbers as well, where the PMI numbers were on the lower side, but the jobs data did slightly better there. The street also is looking at expectations on what China would do when it comes to steel production going forward. Markets also are dealing with higher iron ore exports that we're looking at from Brazil, Australia, and there is a lower inventories at port when it comes to China. And markets also are looking at further restrictions on steel production in China. Also remember, the realtors have been told to not sell pre-sell homes there. So various contradicting fundamentals is what the street is working with. Having said that, the Indian numbers seem quite on the positive side. We almost are isolated for what's happening in the international markets there. So the steel sector is looking at a stronger demand here. And if I could take you through those numbers here, the Indian steel making capacity right now is at around 200 million tons. Target is, or ambition is, for 300 million tons by 2030. And when you look at the iron ore within that, well, remember, India is the 4th largest iron ore miner in the world, and it takes nearly 1.6 tons of iron ore to make 1 ton of steel. So that's the kind of number that we're looking at. This is what we've done in sense of production, 277 million tons last financial year, and the previous one at 289 million tons actually is a record high here. So when you look at the kind of ambition that India has in sense of steel production there, you will need much more iron ore there. Just to reach that 300 million tons, you will need something like 460 million tons of iron ore, and India doesn't have it right now. In addition to that, we also are exporting iron ore right now. So by 2030, whether we start importing, what India does really is import higher grade iron ore and exports lower grade. So there is a lot of mix and match that you would see by 2030. Having said that, this is what the markets do feel about the international iron ore prices going forward. We're trading at around $96 a ton right now, with most global banks and brokerages believing that $95 to $100 a ton is what we could be looking at an average. The only a lower number rather, that I have seen coming in from the markets has coming in from AOCP, or rather Goldman Sachs as well, which is talking about levels of $90, $95 at this year, and even lower in the next year. Westpac, as I was mentioning, 86. They're the only ones talking about 86, and AOC at 80. Apart from that, everybody else believes that it's going to be a range-bound $95 to $100 a ton of an average for iron ore prices this year.
All right, Manisha, thank you very much for that. Very, very informative. We'll take a quick commercial break here. On the other side, it's our segment. It's the economy. My colleague Latha in conversation with Neeraj Seth of Third Investment Management on global yields, rates and currencies. That's coming up in just a bit.